Okay, here we go. The more detailed version for those of you who really want to dive into this banking fiasco. So it is Wednesday night. I don't know what time it is. It's whatever time matches that color out there that you see in the window. That's what time it is right now. Here's what we're going to discuss. Number one. Well, first I'm going to tell you my sources again because this is a separate video. Bloomberg, Bankrate.com, Carson Investment Management, Goldman Sachs Global Investment Management. That's where I got all this information. So first thing we're going to talk about is the US banking system. It's like magic. Then I'm going to talk a little bit about specific banks, including Silicon Valley Bank, which I'll refer to as SVP from this point going forward. Then I'm going to talk about types of recessions, and then finally looking under the hood as far as how we can really take an x-ray or an MRI of what's going on with these banks based on how different securities, different investments are trading. So number one, how does the banking system work? Well, you are FDIC insured up to $250,000. After $250,000, bank fails, you lose that money, essentially. When we deposit money into the bank, that money doesn't stay there. You walk into the bank, you see the vault, and you think that's everybody's money is right there in the vault. No, it's not. It's a very small portion of it, and actually the majority of it's not even kept at the vault. It's kept with the Fed and with the Treasury. The majority of it is lent out. Mortgages, car loans, business loans, whatever it may be. The majority of that money, they bring it in and then it gets lent out. So when you have a run on a bank like we saw with SVB and with Signature Bank, that money's not there. If we all showed up at our bank tomorrow, every depositor showed up to get all their money, it's not there. So that obviously creates a problem, and that problem, it's no different. And here's where my fear in all of this comes in. It's no different than the problems we saw in 2020 with toilet paper. I hate to compare toilet paper to dollars, but the reality is people are irrational. And in 2020, if people acted rationally, there would have been enough toilet paper for everybody. On Friday, Thursday, SVB and Signature Bank, if everybody acted rationally, there would have been enough dollars for everybody. So there really was no problem. The problem was created by people's irrational acts and irrational thinking. Um, so that's how the banking system works. So next, dive into some specific banks I want to talk about. So we had Wachovia, WAMU, Washington Mutual back in 2008. Failed. They got bought out by JP Morgan, Wells Fargo. Just to give you some size on banks. So we're in Colorado. A lot of us, including myself, got some accounts at First Bank. So First Bank, the Colorado bank for you. I should send this to them, see if they'll throw me a few bucks for that little plug there. They're about this size, according to their website. They are $28 billion. Had lunch with one of their executives a couple of years ago. They actually grew from about 15 billion to 28 billion from COVID to now. So pretty impressive. Good on them. And we have like our Signature Bank, $100 billion. Then a little bigger than that was SVB at 300 billion, I believe. Maybe they were at 200. I have that wrong. Signature is 100 billion. SVB was 200 billion. Anyway, I'm just giving you numbers so you can make sense of this. So pretty big bank, 4 times the size of First Bank. And then we've got, rats, I need a different size car. I guess I'm gonna have to go car shopping. But a little bigger than that, we have Credit Suisse, which I'm gonna talk about them because they're in the news. 500 billion. So they're about the size of Goldman Sachs. So Goldman Sachs, household name here, pretty prestigious name. So that's a big bank over there in Switzerland to be in the news the way it is, kind of scary. And then we've got our big dogs. Now we're talking our Wells Fargo's, our cities, I guess, are maybe going to be up there. But JP Morgan, they're about 3 trillion. So 3 trillion, JP Morgan, First Bank. And then we've got Signature and SVB in that 100 to $200 billion range. So let's dive into that a little bit. Interesting. So SVB, Where their problem came in is they weren't diversified. I'm sure you guys have read and heard about that. They're in tech, they're in Silicon Valley, venture capital, a lot of money, a lot of really successful businesses when things are booming, but they're risky businesses. So a typical venture capital firm, if they make 10 investments, they're going to assume 6 or 7 of those are going to go bankrupt. One or two of those is going to break even, and then they're just hoping one or two of those really makes it big, and that's how they make their money. So very volatile. Going back to that FDIC insurance, SVB, on average in the US, about 55% of deposits are FDIC insured, meaning people don't have more than 250,000 in there. So get all their money back. In instances of a bank failure with SVB, it was only about 12%. You think that makes sense because there's a ton of money in that area. So you've got your tech folks who they probably deposit a lot of their deposits are more than $250,000. Roku, the little stick thing, plug into your TV, watch shows. I don't understand how that works because I'm a old school guy. I've got a remote control direct TV. It's crazy, I know. But Roku had about $450 million in SVB. So 450 million divided by 250,000 is a pretty big number that they lost for that time being anyway. So timeline of events, we're still just talking about the banks here. Thursday, this news came out with SVB and then Signature Bank and some of these other regional banks. We had to run on the banks and they failed. They were seized up by the FDIC. The FDA, they tried to find buyers, couldn't get a deal done fast enough because that's way too quickly. So by the time the weekend and special weekend, by the time the weekend was over, they were done. Exactly 15 years to the date. Bear Stearns, the news came out on a Friday, exactly 15 years ago. So that doesn't necessarily make us feel warm and fuzzy, does it? Not saying they were Bear Stearns, but you know, we all remember 2008. I don't need to go into that. So very important in the timeline. Sunday late afternoon, Janet Yellen, Treasury Secretary, basically said we're FDIC. The Treasury's going to cover all those people. No one's going to lose a dollar. And if you're watching stock futures markets at that time, which none of you were doing that, I hope to God, but I was because it was a pretty stressful weekend. Futures markets jumped, and that was a huge sigh of relief for me because I was really stressed out about this all weekend long. Had a lot of conversations with my team in Denver. What are we going to do about this? And wasn't a lot of positive conversations, I guess we should say. So anyway, getting back on track here. That's kind of the timelines. Those are the banks, and then now we're talking about Credit Suisse, $500 billion, having the same sort of issues. So talking recessions and looking under the hood, tackling my last two bullet points here. Will this cause a problem? And the answer is number one, let's address the different types of recessions. That's very important. And then number two, let's look under the hood and talk about credit default swaps. Won't be a quiz, don't worry. Three different types of recessions. And of course, this information there's nothing proprietary about this. Feel free to share it, send it to your friends, family, colleagues. Good stuff we should all be talking about. There's three different types. There's event driven. Those are short. Stock market drops about 30% and they last about 8 months. That's what we saw in 2020. It was event driven. There was an event. Market plummeted and then it came back within 8 months. There's cyclical, which is what I've been telling you and how I've been feeling what we're in right now. Cyclical, they last a couple years and we see about 30% pullbacks in the market, which is exactly what we saw. And that's what I hope we're still in. But with this banking issue, I don't know. This may lead us into the next level, which is the scary level, and that's the structural. That's what we saw in 2008. Structural recessions last on average about 4 years, and the market drops on average about 57%. So I'm not trying to ruin your day. I'm kind of a perma bull when it comes to the markets, and I think markets long term are one of the greatest places you can invest. Ride out the ups and downs, but I do have some concerns. I'm not saying this is 2008, but I'm saying if people act irrationally, like we did with toilet paper in 2020, if now instead of toilet paper it's dollars, the banks can't handle those types of deposits or those types of withdrawals. I mean, so something that myself, the team has taken some money off the table, taken some money out of equities. It's idle cash right now. So if you log in, don't worry, it's not going to sit there in cash. There is a plan to deploy that and um, looking at putting that into things that number one offer downside protection, number two provide some monthly and quarterly dividends and income streams. So more on that in another episode. So looking under the hood, we have to look at to see what kind of shape banks are in. We look at credit default swaps and we look at the spreads. And I'm not going to, you don't need to know what that means. I'll just tell you what the pricing means. This is what they talk about in The Big Short, the scene with Margot Robbie in the bathtub, talking about credit default swaps and spreads. This is exactly what she was talking about. Back in 2007, 8, 9, the spread, which is really just the price of a credit default swap, was about 300 basis points, 400 basis points for your JP Morgans, your Citigroups, your Wells Fargos. So that means we saw a spike in that price, which means bad for the banks. Since then, we've been about 70, 80, 90 basis points right now. That's where we're at. We're under 100 basis points for that, for those spreads on the credit default swaps. Now, if we look at Credit Suisse, different sources say different things, but 900, 1200 is kind of what I've seen. So a little bit of concern there, a little bit of concern for Credit Suisse, which has got to be the biggest bank in Switzerland. I assume it is. Big global bank. We've all heard of it, obviously. So that's how, that doesn't look good for Credit Suisse. If we have an issue with Credit Suisse, hang on. I'm going to be getting a lot of phone calls from you. Hopefully that does not happen. Interestingly enough, I had an attorney who does trusts and things like that. On March 14th, yesterday, he sent out a big article about how US banks have a lot of infrastructure problems and Swiss banks are the place to be. That did not age well. So there you have it. How our banking system works, some specifics on some banks, some SVB, some Credit Suisse, putting all those sizes into perspective, the three different types of recessions, the event driven, cyclical, which are normal, and then structural, which is like a 2008, which maybe we're going into that, maybe we're not. But ultimately, what this means for you is that we've really reined in on the equity positions. Now we're not going to completely give up on the upside potential. I would never do anything like that. So that money will be deployed into what I think is the best place to be invested right now. So there you have it. Pass this on. Sorry, it was a long one, but there was a lot to uncover, and I know it's on all of your minds. So I hope I didn't ruin your day, but I probably did. So I apologize, and I'll see you. We'll send out the Mario video next week. So hopefully that'll generate some smiles. Take care.